market. Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the program, sir. Do we need to rip up the global playbook for investing now?
Oh, I think it's already been ripped up, and it's been ripped up largely because of what's been happening with this payment for security coming out of Europe. As you mentioned before with Ali Crook, they're going to tear up their debt brake. They're going to deficit spend. They're going to spend money like crazy. You could see it with the way that their yields are soaring higher. Their stock markets are soaring higher. Even if you look at their real rate bonds that would anticipate inflation, they're going vertical right now, that a big inflation is coming. And just to kind of lead you a little bit, we've got the ECB meeting in an hour and a half that they're so trapped with forward guidance. It looks like they're going to cut rates right into the teeth of a market that looks like we're going to have the economy soaring and inflation going straight up. And it's going to look like it's a gigantic mistake even before they even make the move.
Jim, it's early days, and you're right that it is consensus that the ECB will cut by 25 basis points. But Ali Crook there made a great point, which is right now what's going on doesn't have a lot to do with Fed or ECB policy. This has to do with fiscal, and fiscal is very much in the driving seat. And I wonder whether it really just permanently shifts higher yields, not just in Europe, but globally, including the United States, going into the future if, and it's a big if, some of these plans do go through.
Yeah, if we assume these plans go through, you're going to see much higher rates in Europe. You're also going to see higher stock markets, too. You're going to see higher rates around the world. Japan looks like it's finally recovering. It's got a higher inflation rate than the U.S. Their rates went over 1.5% for the first time since 2009. So rates around the world are going higher. In the U.S., we have an inflation problem. We had a monster inflation number in January. We have a trending higher inflation. The prices paid index for both ISM services and manufacturing was above 62 for the first time in 3 years, which is when we had a big inflation problem. And if you took University of Michigan, looking at the highest numbers in 30 years on expected inflation, our interest rates should be going straight up too. Why aren't they? Because we're stuck in the mud thinking that this tariff thing is going to cause a recession. But if we ever get off of that idea, there won't be a recession because of tariffs. We could see a massive snapback in yields here following the rest of the world higher, and maybe even substantially higher, back to like the 480 level, or not higher, even higher than that. 480 is where we were in January.
Some people would argue that the reason why people are looking at lower yields and more disinflation is because we're hearing from companies themselves highlighting how they cannot pass along higher costs. And what you get is maybe a price adjustment, but after that, you get slower growth, you get slower sales. And you're seeing that in terms of corporate messaging pretty much across the board. Why do you reject that? And you think that inflation is going to be the sticky aspect of this that will remain?
If you look at the way that we've been talking about tariffs in the last several months, we're not sure exactly what we're supposed to do with them. And I'd like to joke, I'm old enough to remember January when tariffs were inflationary. Now in March, tariffs are recessionary. What are tariffs going to mean in April? Are they going to be stagflation? We're going to go back to inflation. We're not exactly sure which way they're going to go. I get the uncertainty, and I get that it is driving everybody. We're not exactly sure what their impact on the economy is because we're not exactly sure how long they're going to last. We're worried about tariffs now. Donald Trump hasn't woken up, and we'll see by 4 p.m. when the stock market closes if we have the same view as tariffs as we do right now. And so these things are going to constantly change, and we don't know how long they're going to last. But if they don't could produce that kind of drag on the economy, we're back to fiscal stimulus around the world, big inflation numbers here. And that would be a cocktail for higher interest rates had we not been worried about this recessionary call with tariffs.
Well, Jim, from the market's perspective, it's quite challenging when it comes to the tariffs because they're not even sure which ones are going to stick. And April 2nd, they're not even sure which ones may be introduced. The president said at his joint address to Congress, this will be disruptive. And then the next day, Howard Lutnick came on this program and said, we're going to meet in the middle and potentially there's going to be some reprieve. How much pain do you think this administration is willing to take?
I think that they're probably willing to take a little more pain than everybody thinks. That's why their focus is the 10-year yield. Scott Bessent said, look, you guys in the stock market, you had 220% years back to back, and now you're unchanged after 3 months. Don't come crying to me about that just yet, at least. And if these tariffs cause the pain that we think they're going to cause, they're also going to cause pain in Europe, in Canada, in Mexico, and in China as well, too. And we'll start seeing it in their markets. Right now, their markets almost seem to be ignoring tariffs like we were talking about earlier. In Europe, they're so talking about the fiscal situation, they haven't noticed tariffs. Here we talk about tariffs so much, we haven't noticed their fiscal situation. So eventually, I think these stories are going to start to bleed over across one another, and then we'll probably see an agreement on tariffs.
Hey, Jim, appreciate your time. What a market. Jim Bianco there of Bianco Research on the global economy and financial markets as well.